Hello, everyone, and welcome to another great episode of the Jason Howell Company Speaker Series Zoominars. My name is Jason Howell, and as always, I'm excited to share some of the people in our network, especially the people that we may work with to service some of our clients. There are just so many great people out there, and as financial planners, we have a wonderful opportunity to work with people and bring them all and build that team. Today, we've got a great episode. We've got Gabe Rissman from Yourstake.org. And we're going to learn a little bit about stakeholder capitalism and what they are doing to make that a real thing as opposed to something that's amorphous, really get into some of the data. But before we do that, let's just meet Gabe. Gabe, how are you doing today?
Jason, thanks so much for having me on. I love that you asked that question, by the way. I'm excited to do my first ever Facebook Live event. That's pretty cool. Feeling refreshed after Memorial Day weekend, got to spend some time with my family. So I'm feeling great and really glad to be speaking with you too. You are such a huge supporter of Yourstake, and I also am a big fan of everything that you're doing.
Wow,
spreading the word about ESG and like taking it really seriously and going all in on stakeholder capitalism and impact.
Well, welcome, Gabe. I'm so glad you feel that way. The feeling is mutual for sure. I'm so glad that you're so smart and that we can leverage your mind for the kind of things that we're trying to do as a firm. And I think a lot of us are trying to do just as a community, but we don't want to be embarrassed, right? We want to be able to say we're doing this and it's not a political thing. It's just a thing that we're doing for the good. And again, not feel embarrassed, not feel silly about it. So I'm glad you're here and I'm looking forward to having this conversation with you. Well, I know one person has come aboard so far. As people kind of ping in, I will hear that ding at least, and I'll let them into the Zoominar here. Regardless, this is going to be recorded. We're going to have it available. It'll live forever on Facebook's site, and it'll hopefully also live forever on YouTube. So I hope the folks not only watching live, but the people that watch it later are going to enjoy it. All right, with that, I'm going to go ahead and share my screen. And if you came to Stakeholder Capitalism by Yourstake.org, or if you're just swimming by Facebook and you're interested in seeing a really cool conversation, then you've come to the right place. We are so happy to have Gabe Rissman here, co-founder of Yourstake.org and so many other interesting little organizations. But before we get to some of the Q&A, let's just get a word from our sponsor. And our sponsor today is the Jason Howell Company. Jason Howell Company is an independent family wealth management firm that uses sustainable, responsible, and impact investing to develop family leaders into patriarchs, matriarchs, and stakeholders of their local communities. Most of our clients are double income Gen X parent households who have earned, saved, and or inherited an unexpected amount of income or wealth, and they're interested in philanthropy, and they want their investments to perform, and they want to serve the greater good. And so there's a lot that goes into the kind of folks that we bring in. We just know they want to do something special with their lives, and that happens to include their resources. For more about Jason Howell Company, just go to jasonhowell.com. And now the star of our show, Mr. Gabe Rissman from Yourstake.org. Once again, we are so happy to have you. I know any of you that are here watching saw the newsletter, you saw the bio. For those of you that are just watching this via some of the social media, well, here is his bio. I won't read it out loud, but I will pick out a couple of things that just strike me. The first thing here is computational astrophysics. You might need a degree just to be able to say that phrase, and I have a degree, thankfully. So I was able to say the phrase, but please, Gabe, can you tell us about computational astrophysics and what the heck that has to do with ESG, SRI, impact investing?
Sure. So first, I have to bring up the elephant in the room, which is my hair. I did cut it since this photo was taken, and a lot of people miss it, but I'm glad I don't have to worry about shedding or anything like that anymore. It's a lot to manage.
We will miss it, and I might have saved that for last or something. But this is an important photo. Where was this, Gabe? We should just talk about it.
Sure. This was in Prospect Park in Brooklyn. Right outside. I live about 90-second walk from Prospect Park. It's kind of the one place that I feel is wild within New York City to some degree. So
you get out there a lot?
Yeah, I try to get there every single day for at least a deep breath.
Okay. Wow. Terrific. Prospect Park, you said.
Mm-hmm.
Okay, terrific. All right, now computational astrophysics, please.
Sure. So I did my thesis on something called dark matter halos. And dark matter halos is essentially dark matter is this stuff that surrounds every single galaxy that we can't see, but we know it's there because it influences everything else that's around it. So my question was, how can we look at the motion of stars and the motion of galaxies to understand how dark matter forms around them? So that's what I did. And a lot of times physics is theoretical and it's kind of writing equations, figuring that stuff out. But for computational astrophysics, a lot of it is just doing data analysis. So we have all this data about all the galaxies that exist in the known universe. And then we look at how they're moving, how big they are, what their brightness is, all that stuff. And we take that information to be able to process huge, large data sets and come up with insights about how the world actually works and how that relates to ESG. ESG is a very similar thing, tons of information, tons of data out there, but it's just this big soup, and it takes a lot of processing and analysis to be able to generate insights that actually help you understand what's going on in the world.
Dark matter to ESG. Fair. I don't think anyone has the capability to argue with that. So we've started out pretty well here. Terrific. Well, how about the academic papers that you've written? So much has sort of been labeled around ESG as maybe just amorphous, not necessarily credible. And here you're writing academic papers. Number one, are you the only person that's done that? And number two, what inspired these?
Sure. So there's actually a really growing field of academic papers that are focused on ESG and socially responsible investing and impact. The biggest one that I wrote actually informed Real Impact Tracker, which is an organization that I co-founded before Yourstake. And this academic paper was focused on the question of how can I create the most impact through investing? And it really came from this massive debate that was going on in 2016 in particular around, should I divest to create impact from fossil fuels or private prisons or whatever it may be? Or should I focus on shareholder engagement? And if stakeholder capitalism, if I'm a shareholder or a stakeholder in a company, how can I use my voice to create impact and push that company to change? Then there's also the question of ESG integration or community investing or venture capital or whatever it may be. And there was just so much going on that my question was, all right, well, what's the best? What should we actually do? What actually works? What doesn't just make you feel good, but creates impact? So the first academic paper that we did was a review of a whole bunch of literature across many different domains, looking at the impact, not just of, for example, shareholder engagement on environmental and social issues, but how investors have pushed companies to change their financial results and improve their governance, and what divestment has done to companies and how changes in stock price and changes in public perception are all interrelated. So that was the main thesis of the first academic paper, or not the first actually, but the major academic paper that I wrote. What can we all do? And the conclusion that we kind of came to 4 years ago is starting to come to fruition, which is really exciting and still very relevant. The conclusion is that what will allow for the most impact is essentially ESG investors becoming and behaving like the majority instead of the minority. So for decades and decades and decades, there have been people that have focused on socially responsible and ESG investing, and they've been oftentimes small players that have punched way above their weight and pushed companies to change. But in order to create massive scale and massive impact at like economy-wide scale, the power that comes from having coordinated ESG and having a critical point and a larger number of investors in ESG, that is something that can actually change the world in really substantial ways. So Yourstake kind of is a result of that paper, where we then looked at, okay, well, what are the challenges? Why are we not reaching scale? Why do 80% of people want to, or more, depending on the study that you see, want to align their investments with their values. But again, depending on the study, only 10 to 30% of people actually do that. Like, what is the cause of this gap? How can we take ESG from minority to majority and really unleash the impact that can come from that?
Yeah, and one of the first webinars I was on was financial advisors are the reason for the gap. I think it's about 6% of advisors have any belief in any of this, but as you stated, 80 to 90%, depending on what study you look at, of investors are interested in this. And so, it's the people at the door that tend to be more resistant than the people writ large, which is incredible, just incredible. Well, before we move off your bio, the other elephant in the room, or I should say bulldog in the room, is your attendance at Yale. I mean, that's exciting. Not many people have gone to Yale that are alive anyway. Those who do, we kind of look at them with, some interest. So tell us, how did you get yourself to Yale? I mean, why that school, and what did you think of it?
Sure. I really loved my experience there. Everyone was interested in everything pretty much. So you would have conversations. I was part of a book club, and everyone would bring in articles or books or movies or whatever it may be. So I guess it wasn't strictly a book club, but people just love to essentially share knowledge from one domain, like biology, and see how this biological information is relevant to investing, or is relevant to economics, or is relevant to philosophy, or whatever else it may be. So that was kind of what drew me to it. And I also, I think it might be a Mark Twain quote, and apologies if I'm misquoting, but there is a really great quote about don't let your schooling get in the way of your education. And
Okay.
I kind of live by that. I worked hard in classes, but I spent most of my time in extracurriculars as a climate activist pushing for Yale to divest from fossil fuel companies, which it actually now just followed those recommendations and did about a month ago, 9 years after we proposed it.
9 years.
And,
Well, hey, they're an old company. They're an old school.
yeah, it's true. It does, well, that's the thing about big ships. It takes a long time to steer them, but there's a lot of impact when you do. So yeah, I love that I got the chance to really explore a ton of climate activism and socially responsible investing outside of the classroom, that we were given the resources and support to be able to do that and learn in a whole bunch of different ways.
And the Yale endowment is famous in investing circles, certainly set the pace for other universities, nonprofits, even some pensions. There is the Yale way of investing. And the gentleman who really was the catalyst for that passed away just recently. Isn't that right? Last month, I think.
It was, I think, 2 or 3 weeks ago also. And I would also just like to say, so David Swenson was always extremely respectful anytime we as activists came and spoke with him. And I really love what he's done to grow the endowments of a lot of nonprofit institutions and universities that have followed in his lead, which helps people learn. It helps these educational institutions accomplish their mission. So I'm a big David Swenson fan. He treated people with respect and really listened to what we had to say as activists. So yeah,
Just wanted to hear that. It's great to hear that indeed. Rest in peace, David Swenson.
Rest in peace. Yeah.
All right. Now we'll get to the Q&A portion of our conversation. Thank you so much, Gabe, for sharing a little of your background. I mean, we made the hair even bigger on this slide, and so we just had to get to know you before we popped out here. But the first question, I think, is on the lips of everyone who either is going to be watching this later or watching it now, is really, what is your definition of stakeholder capitalism?
Sure. So stakeholder capitalism is incorporating all of the ways that a company or the economic system has impact. What are all the downstream effects and the upstream effects of every interaction that happens? For me, I see stakeholder capitalism as two primary, distinct, or different things from what you might normally think of as a capitalist system. The first is it's much more holistic. It doesn't look at companies in isolation. It looks at systems, and it looks at how companies might be rewarded or not for their contributions within the entire economy, what their externalities are, if they're providing public good, how they're treating their employees, everything like that. And the second, which is kind of related, is it's not just a more holistic way of looking at capitalism spatially, but we'll go into some of the physics.
Uh-oh,
We've got the
hang on,
spatial
everyone.
dimension, and then we also have the time dimension. So that's really important too, is stakeholder capitalism has tended to be much more long-term focused. So I would say probably the best way to describe stakeholder capitalism is with an example. A company that is focused on stakeholder capitalism is not focused on their short-term profits, but instead it's focused on what will provide the most long-term value to employees, to shareholders, to communities, to really everyone that's involved.
When we think of this concept, does it seem like it's a brand new concept to you, or does it seem like we kind of need this concept as a reminder?
Oh, that's a great question. I would have to think that actually capitalism in its earliest form was probably more focused on stakeholder capitalism. I think capitalism kind of grew a lot of times out of it was really interconnected with the government and was a more efficient way to be able to accomplish particular goals. And then I think the revolution, the thought revolution led by Milton Friedman drove that focus to more shareholder capitalism. And I actually think that you can stick within the Milton Friedman shareholder capitalism model and still have a much more of a focus on ESG and social impact, knowing that shareholders are also people and want to be able to live in a world that exists and that's free of discrimination, and that's free of gender violence, and that's free of human rights abuse. Like, shareholders don't just value profits. Shareholders are people that value all these things as well.
Equally,
And
and
long
there's
term, whatever is best for just like promoting the economy is best for shareholders. So I think my contrarian opinion a little bit is that there shouldn't be that much of a difference between shareholder capitalism and stakeholder capitalism. They kind of should converge into what's best for society and for long-term values of shareholders and also stakeholders as well.
I agree with that opinion, and a couple of the people that we've had on these Zoominars before look for a day when it's no longer, ESG or SRI investing, but when it's just called investing, and for the very same reasons. And this conflict between short-termism, quarterly reporting versus long-termism is pretty old. And most value investors, of which we are with our clients, value investors, have long thought that investing for the long term is the way to go. I mean, that's even ridiculous to say it out loud. Of course, we're value investors, but even most investors who are not just trading at the end of the day and back and forth, and your day traders, most of those real investors, I would say, are looking at the long term. But yes, we have an entire industry that really does point to that short term more and more. There was an old book out there, I think it's the early O's, by the late great sort of founder of the Vanguard fund. So he wasn't actually the founder, but Jack Bogle. And it was called Saving the Soul of Capitalism. And I'm just a few chapters into it, but it is very much about this conflict between short-termism and long-termism. And he was known as the patron saint of the kind of investing that many of us believe in. So it is interesting to see this continue.
And Jason, I'd love to hear your thoughts, particularly on something like Vanguard. Sure. Vanguard's awesome in providing low-cost ETFs for a lot of people to be able to access and participate in the financial system in ways that they couldn't before Bogle. He's really a pioneer, and it's awesome. Vanguard also invests in every single company in the economy. Right. And I wonder what you think about Vanguard's like incentives and Vanguard stewardship practices and policies, where do you think that investors that are investing in the whole economy have the incentive, and would it behoove them to push for broader stewardship to eliminate externalities? Like if you're investing in ExxonMobil you're investing in some petrochemical company that's polluting a river, and you're also investing in all these companies downstream on that river, that's not the most efficient thing. Maybe the best thing to do is to not just get the one company upstream to maximize its profits, but to think about things on a portfolio level. And how do you think about things on like an economy-wide portfolio level, or do you see any investors that are taking that approach? Maybe some of the the fund managers that you work with or that you're familiar with?
Yes, yes, and yes. There's so first in your questions around Vanguard. In this area, it's tough to be one of the biggest. BlackRock has this challenge as well, and we look at all these funds when we're evaluating clients. Thanks to Yourstake.org, we can really see what the delta is between funds that call themselves ESG and funds that are just good funds. And we don't have to look at the moniker to make that decision. We can see the data, which is really why I'm so happy that you are here and that you know astrophysics. But what the challenge that the big firms have and that many large firms have is that there are 5 areas of what we call ESG integration. And part of that can be screening out bad companies, 1. Another area could be screening in good companies, 2. Another can be looking at themes. But another one of those, and maybe one of the more important ones, is going to be proxy voting and that kind of activism and what you're doing. And there are conflicts for the larger funds that we need to parse through and work with our clients when that's the case, because there are reports of not as much support for the issues that at least the funds are descriptive of saying that they care about. But like you say, there's some downstream effects and there are other companies that they're participating in. So it becomes a real challenge to say that the firm writ large, the organizations writ large, these brokerages writ large are wholly supportive of the kind of investing that we're talking about. And in reality, I guess they can't be, because they are the market. And right now, 1/3 is huge. 1/3 of all investing, about $20 trillion, is really pointed towards the kind of investing, ESG integration, that you're speaking of. And that's just in the United States, 1/3. And it's growing very quickly. Well, what about the other 2/3? Well, the BlackRocks, the Vanguards, the Fidelities, they're big firms. They have the other 2/3 as well. And so until you, like you said, the way we invest is inclusive of this by default, they're going to have challenges, sort of tripping over the global amounts or opportunities for investing to streamline that over time. But we do take this into account when we are working with our client portfolios, and we think like you do that this is something that's coming because it's growing so very rapidly. My definition of stakeholder capitalism is, it kind of goes back to the whole sort of thesis around capitalism and democracy. Capitalism will devour itself over time if you let it. Democracy is there as a balance, and that's what makes this country, so fantastic. It's what made it so successful over these past 200 plus years, is that there has been a balance of capitalism and democracy. And whenever we have challenges with that, whether it's during the robber baron era of the 1900s, whether it's during the roaring 20s, whether it's right after the Financial Modernization Act of 1999, which leads in 7 years to the economic collapse of 2008, whenever we've had these problems, it's because there's been an imbalance between the government's role, i.e. our democracy's role, and capitalism's role. And we always have to work to even up that balance so that we get the benefits of capitalism, which we have as the biggest economy in the world, and the benefits of really good democracy, even as a republic. And so I look at stakeholder capitalism as the concept, as the phrase we needed to be able to say what the heck this is. But it isn't new, in my view. It's just a really good term that we can use to get a little bit more clear. And hopefully over time, we'll be able to depoliticize it and really just work for the greater good.
Can I steal your definition next time I get that question?
Please do. I don't remember what I just said. So please do. No, that'd be great. Well, let's move on to the next question here. How can consumers and investors measure this thing called stakeholder capitalism?
Yeah, that can be really, really tricky. That when I mentioned the goal of our research was to figure out how we can encourage the scale and making ESG and stakeholder capitalism the majority. The biggest challenge that we found was it's so hard to measure it and figure out what's going on. It's really tough. And I think what is difficult right now is that a lot of ESG and socially responsible ratings providers that are really popular have a particular methodology and approach that is relying on their analyst opinion. And their analysts are determining that transparency counts this much, and that human rights counts that much, and that financing fossil fuels counts this much, and direct emissions counts X, and indirect emissions counts Y, or whatever that may be.
Yeah.
And for some people, that might not matter at all because maybe your mother died of lung cancer, and what makes a company ethical and what you care about is, are they a tobacco company? And it doesn't matter if they're the most diverse company with great climate policies. If they're producing tobacco, that's not something for you. But for other people, they may be totally fine with tobacco and they would care about climate impact or human rights or whatever else it may be. So that's the biggest challenge I think that exists right now in measuring stakeholder capitalism, is that there are ratings that are out there that are a particular ratings provider's opinion. And that's something that's available for people to see, but it's really hard to find out how much a company or a fund aligns with your own values. And go for it.
Well, let's lean into that a little bit, because I have heard this from people who have this very strong opinion about ESG and related types of investing. And they say that very thing, because there are about 10 or 11 rating agencies, and the data shows that they're off by a wide chasm on what they believe one way or another. Mm-hmm. And people point to that and say, well, look how off they are. That's ridiculous. Because if you look at, say, the bond rating companies, they're off by fractions of percentages. So they're so much better. To them, I say, well, was that better during the 2008 crisis where we had 3 bond agencies that kind of all said the same thing, and credit default swaps that were all terrific, and then they all crashed at the same time? So it's a sort of a specious argument if that alone is your reasoning, the fact that they're different. But I do know, and I know that that they evaluate things differently, and at the very least, we need to be able to easily understand what those evaluations mean, whether it's MSCI or Thomson Reuters or Bloomberg. Do you think there's enough transparency about how these rating agencies are developing their content?
That's a perfect question. And one other thing that I add to that is a lot of the rating I think the biggest point of confusion that exists is that ESG and impact oftentimes get mushed into the same concept when they're very different. ESG is, hey, let's look at these environmental and social factors and governance factors and see which of them correlate the most with financial performance. Hey, it turns out gender diversity, when you have more gender diversity, you tend to perform a lot better financially. So that's kind of ESG. Which of these metrics lead to that? But then impact is very different. Some people might want to invest in companies that have high diversity for an outperformance perspective, but other people might just care about gender diversity or racial diversity or whatever it may be, and want to invest in those companies from an impact alignment perspective. So generally, these rating agencies, they're looking at those correlations. They're looking at which metrics are the most relevant and most material for corporate financial performance. And it's very similar to, I guess, investment analyst opinions, right? Where you've 7 buys and 3 hold recommendations and 4 sell recommendations. There's going to be divergence. So that's something that I think explains why there's divergence there. And then from the impact side, no one can tell you the impact of a company without you first saying what you care about, because it's really specific to, just like no one can say that this politician is good. Well, it depends on you agree with their policies or not.
Right. Great point. And there's so much there, but I think we'll get a little bit of it when we speak a little bit about Yourstake. So tell us about yourstake.org. When you put this together with your partner, and really, how does it separate this, or I guess help solve this challenge around data?
Sure. So Yourstake takes, sometimes we call it a no score ESG approach. where we're not ratings analysts providing opinions and telling you that this is a 6.8 out of 10. We are providing, well, first, what we do is help advisors, and you're using this tool, Jason, is help your clients figure out what values they care about most and that they want to incorporate into their investments. Start with that personalization of what really matters to you. And then from there, what we provide is fully transparent reporting on how your portfolio might be relating to and interacting with the particular values and the specific values that you say you care about. So if you, for example, care about toxic air pollution, we might call you a planet protector. You might be someone that is an environmentalist. And if you want to look at the toxic air pollution within your portfolio, what Yourstake is providing is not a toxic air pollution score. It's not you get a 9 out of 10 on toxic air pollution. We're showing you how much toxic air pollution is in your portfolio compared to your benchmark, and then actually showing where that's coming from which companies in your portfolio, which facilities, and the description of which chemicals are involved. So our solution to this challenge of ESG confusion is personalization and transparency to help make the ESG a lot more meaningful.
What I would love to pick up on again is that no score ESG. I hadn't heard that phrase or read that in your materials before, but it's interesting. My guess is the Bloombergs, the Thomson Reuters, the As You Sows, all these other organizations, MSCI, they created scores to make it easier so that people could say a 9 or a 6 or a 4 or a 3, I can get that, or AAA or CCC makes it easier. But by covering up the data in that way, it sort of invites this opportunity for confusion, right? Especially since they have different numbers, because it might be 9 out of 10 here, it might be 86% here. How do you compare those two? You say that Yourstake kind of came at this with no scoring. Here's the actual data, and this is how you can compare it.
Totally. And the ESG data industry was created to serve the needs of a portfolio manager that needs a lot of scores. And then you want to get rid of the ones with the worst scores and take the ones with the best scores, and to make it easy. Exactly. But there was never really that translation from these scores to meaningful client reporting. And that made it challenging for, you said financial advisors might be the gatekeepers to ESG earlier. That's what makes it hard for a financial advisor to get excited about ESG, is they might have an optimized and efficient ESG portfolio, but if you can't tell the story and communicate that to a client, then that's not something that will actually provide meaning and help your practice. And if you're a client, especially because so many people have so many different values on ESG, if you're given an 8.6 out of 10, that doesn't necessarily mean that much, even if, again, it's optimized and efficient from an ESG perspective. The people that are actually the asset owners and that are deploying this capital and investing it want to know more about what things really mean.
One of the things that was appealing about Yourstake, and in case it's interesting for people, we are a client of yourstake.org. After a pretty heavy search of looking for different tools that we could use and feel very comfortable with to use for our clients. And this really bubbled up to the top. So one of the things that we appreciated that sort of bubbled up to the top is that you're not reliant on the back end from just the corporation's voluntary data submission. You're actually going and looking at other data. Talk about that.
Sure. Some of the biggest challenges with voluntary corporate reporting is that companies are oftentimes sneaky. They're putting this reporting out because it's a marketing thing for them, right? So you can always tell, for example, I was looking through a bunch of sustainability reports. You can always tell that a company is embarrassed about its percent women in management positions when it doesn't report its percent women in management positions. Okay. But instead, what it does report is the percent of new promotions that are female, or it will report some other like tangential, the percent of women in management in the USA or in whatever subset. So companies are not consistent necessarily in their methodologies for reporting this information. A lot of companies don't disclose it. and it makes it hard to compare numbers across different companies. On the other hand, when companies, instead of doing a voluntary sustainability report or putting information out on their website, if they're reporting to a government agency or filing with the Securities and Exchange Commission, they have to follow a strict and consistent methodology. And then when third parties like nonprofits or academics collect and create data points about particular companies, they are also applying a consistent methodology. So Yourstake seeks out the best nonprofit data sources, the ones that are being consistently updated, that are fully transparent, and that are already being used by the investor community or the regulatory community to engage with companies. And we try to avoid as much as possible that voluntary company reporting, which can have inconsistent methodologies and are really meant as promotional marketing materials. And a funny thing, there was a recent JD Power study that had company websites and reporting as the number 2 place where people get their ESG data from, I think only after social media. So wow. the sources that people are currently getting their data on sustainability from corporate side, well, maybe this counts as social media if we're going on Facebook Live.
Maybe it does.
But there's a lot of need for standardization and comparability and rigor in this field.
Yeah, and education, and maybe you'll dark matter the stuff and it'll all be simple enough for us to understand. Well, where do you see stakeholder capitalism going? And maybe you can include in your answer where you see the tool that you created going in the next, say, 6 months.
Sure. I think stakeholder capitalism, what's needed is still more education. And that's why I'm really, really glad to be on this podcast in particular, is there's so much confusion out there and so much lack of knowledge about the power of stakeholder capitalism, and how every single individual, if you have a retirement fund, if you have a retirement account, if you're an employee of a company, really everyone can use their power and their voice to align their investments with their values, and also encourage companies to align their operations with what you as an individual care about. There's a lot of power in these numbers. And where I see it going in the next few months, and Yourstake going in the next few months, is providing that education so that people can know first what's going on in your portfolio already. Does that line up with what you expected? It's really fun to see how many people are shocked to see companies that they are horrified by in their portfolio, and then they can actually take action to do something about that. So step 1 is that knowledge and understanding process, and that's what Yourstake is currently suited for. It's a diagnostic. Where is your portfolio right now? Where can it go? Where can it be? How can it be better? And then step 2 is actually something that Yourstake is getting more and more involved with, is the community side of stakeholder capitalism. Is the proxy voting side of stakeholder capitalism, is that using your voice side of stakeholder capitalism. So when you see that some company in your portfolio has a tremendous amount of toxic air pollution, or has 0 female directors, or is providing financing to prison companies, and you don't like that, then actually the way that Yourstake started, and what we're moving more and more in the direction of, is allowing people to let their fund managers or let their companies know, and this is not something that I'm aligned with. Hey, I'm a shareholder and I invest in your mutual fund and I don't align with the prison industry, and kind of more and more people activating, using their voice. And we found the best way actually is channeling that voice through your financial advisor. So essentially you, Jason, and other advisors like you, representing the values of your clients, helping them invest in companies that align with those values, but no company is perfect. So recognizing the ability to use voice and proxy vote and sign on to investor letters to encourage companies to change and help create a more impactful society.
And so that's Yourstake is going to facilitate some of that in the future.
Yeah.
No, it's terrific. And for those of you who are unfamiliar, the idea of proxy voting, you get proxy votes in your mail all the time, or maybe sent to you via email, and it's typically something people will just toss, but it really is an opportunity to vote on things like the board of directors at, oh, I don't know, an Exxon. And I'd be remiss if I didn't say just last week where we had a historic event that two new board directors were elected / appointed to Exxon from activists that were managing the proxy votes of many, many different people to say, hey, fossil fuel, company, we'd like you to start looking at climate change and improving what you're doing and everything else. And to do that, we'd like you to have new directors. That I don't believe has ever happened before. And the fact that it did happen with Exxon, formerly the most profitable company in the world, is a real big deal and a historic event. And it's pretty neat that Yourstake is going to help not only some clients, but our clients, let's say, work in that kind of world of proxy voting. So thank you for that, Gabe. I do appreciate it. All right. And I know our clients do. I'm going to stop the share here. So prepare for, actually, I usually say bigger faces. I don't think we're going to get a bigger face than this one, but smaller faces to some degree. So glad, Gabe, that you came to explain just some of how your tool works, but also the genesis of why you did it, where you see it going, and really why it's just so important that we as consumers and especially investors find a way to impact the world through the way we invest our retirement, our brokerages, just the way that we take our accumulated funds and do really good with it long term. For me, I'm so excited that we're going to be able to do that more and more with our clients. You don't have to be a millionaire to do this if you get to work with folks that have had some pretty good savings. So it's pretty exciting. Well, let me say this, Gabe, before we go, I know Prospect Park is something we should check out if we're ever in New York. So I've learned that, if nothing else, and hopefully everyone that watches this will learn that, but not crowd the park too much with what you enjoy on a daily basis. But can you leave us with one bullet point of what you think is perhaps the most important thing we take away from this conversation?
This is what drove me into what I'm doing. There's so much potential to shape the world and create change in the way that you want to see it through your portfolios and through investments. And Jason, I have so much admiration for your work in helping to guide people to do that through philanthropy, through their investment portfolios, and do it in a way where they can continue to grow their wealth and not have that fear of still being able to have a healthy and happy retirement. The potential exists. It starts with education. It starts with building an understanding of what's actually happening and going on. But there's just so much ability to create change and have real impact and not just a pat on the back. And I'm really honored to be able to be in the space and work with people like you to try to help make that a reality.
Terrific. Yeah. Gabe Rissman, former astrophysicist, dark matter aficionado, Prospect Park plunderer, and co-founder of Yourstake.org. Thank you for being with us. We have learned so much. And with that, we'll yield the balance of your afternoons. Take care.